Testing 1, 2, 3.
Alex or Kyle, could you make Melissa a co-host again?
Order the special meeting of the Credit and Risk Mitigation Committee and the Board of Investments for
Recording in progress.
Okay. I call to order the special meeting of the Credit and Risk Mitigation Committee and the Board of Investments for the Los Angeles County Employees Retirement Association, and the time is 8 o'clock.
Thank you, Ms. Jones. This meeting is being conducted as a virtual meeting and in person, so I will do a roll call of the trustees to confirm attendance. Mrs. Jones?
Here.
Mr. Jason Green?
Present.
Mr. Rue? Not here. Mr. Knox?
Good morning, I'm here.
And Ms. Sanchez? Here. Okay, staff participating in the meeting includes the following: CIO John Grable, CEO Santos Kryman, DCIO Jude Perez, Chief Counsel Stephen Rice. Investment staff include Vache Mesaragian, Chad Timka, Kwok Wen, Jason Cho, and Crystal Powell. Consultants on site are the Makita Investment Group in Alborn. Trustees, please use the raise your chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak, and now we will proceed with the agenda.
Very good. So we will skip number 2 and 3 for now. We'll come back to those. Let's go to public comment.
We don't have any today.
No public comment. Awesome. All right. So we're moving on to our non-consent items. So the first presentation is a credit structure review. Do we have a presentation?
Good morning, Madam Chair, committee members, and trustees. On the agenda today are structure reviews for 2 of LACERA's functional asset categories. We'll start with the review for credit, followed by the review for risk reduction and mitigation. For each functional asset category, we'll cover 5 broad topics: role and objectives, current structure, risk and return, recommended changes, and initiatives. And of course, we'll conclude with a summary of recommendations. During our first presentation, please bear in mind that the key distinction between credit and equity investing is that when LACERA makes an equity investment, we're taking an ownership stake in some entity, whereas in credit investing, LACERA is lending money to an entity that has a contractual obligation to repay us with interest. Before we dive in, I'd like to highlight 3 points. First, in preparing these structure reviews, we endeavored to take a fresh look, independent of the current structure. We started with a blank sheet of paper with no preconceptions, and we invited input from LACERA colleagues, our investment managers, and our consultants. Nevertheless, the outcome of all that analysis is a recommended structure that's not very different from what's currently in place. In other words, we believe the structures that the trustees adopted back in 2021 remain appropriate today and are serving the fund well. Therefore, we're not recommending material changes. The few recommendations we are making can be viewed as refinements or modifications rather than an overhaul. Second, although we typically do a structure review every 2 years, we'll likely return next year with further adjustments to incorporate any changes resulting from the triennial strategic asset allocation that was recently launched. Third, I want to briefly review what an unusual and tumultuous economic environment we've been in the past few years. In response to a pandemic that led to a global recession, central banks around the world acted jointly to cut rates and inject liquidity to prevent an even more severe decline. As economic conditions improved, some argued that central banks were slow to remove the injection of liquidity and that the delay contributed to a spike in inflation last year. In the US, inflation peaked at over 9% in June of 2022. No doubt Russia's invasion of Ukraine and heightened tensions with China exacerbated these situations, but nevertheless, the Fed did embark on a tightening campaign starting in February of last year. And today, after 10 additional rate hikes, inflation is back down to 3%, and we expect to get the July figures tomorrow. The spike in inflation led to a large and rapid increase in Treasury yields. For example, the yield on the 10-year Treasury increased from 1.5% to 3.8% over the course of the year. Since higher yields lead to lower bond prices, the 10-year Treasury suffered a return of minus 16% last year. Longer maturity Treasuries fared worse, shorter maturity Treasuries fared better. On the whole, the broad treasury sector had a negative return of 12.5% in 2022. Now, you might be wondering, why am I talking about treasuries in the introduction of the credit structure review? Well, it's because treasury securities are bellwethers for all other bonds. And the combination of higher treasury yields and wider yield spreads caused by concerns about borrowers' ability to service their debts led to a double whammy of sorts for most sectors, including corporate bonds. The Bloomberg Index of investment grade corporate bonds registered a return of negative 15.8, the worst return in the index's 50-year history. And because the index of investment grade bonds has a longer duration, it actually underperformed the Bloomberg Index of high yield corporate bonds, which was down 11.2% last year. Its second worst performance on record, second only to the global financial crisis in 2008. Now, bank loans fared better given their floating rate structure, as LACERA's loan benchmark was down a more modest 1.1%. Now, as you know, credit consists of two categories, liquid and illiquid. Chad will cover the overall credit category, then Kwok will cover the liquid credit, and Krista will cover illiquid credit. You probably recall that at our previous committee meeting in May, we had a guest speaker from Allborn, Kristen Jones, who provided an overview of private credit, which we call illiquid credit. Despite the challenging backdrop that I highlighted, LACERA's credit composite outperformed its benchmark, as you will see shortly, and most of the outperformance came from illiquid credit. Now, before I hand off to Chad, I'll note that support memos from Allborn and Makita are included in the appendix to our presentation materials. Chad?
Thank you, Vache, and good morning, everyone. Good morning. If we could move to slide 3, this laptop's not working. This diagram here identifies the role of credit as using a moderate implementation and in order to deliver moderate outcomes. This role is a guide when considering the relative risks, liquidity, returns, and also considering the income associated with the portfolio. You'll hear us repeat the word moderate several times today, as the concept permeates how we think about credit and how we implement credit portfolios. Next slide, please. This page provides additional detail on the objectives of the credit portfolio. Specifically, we seek moderate outcomes by emphasizing contractual yield, fundamental underwriting, and creditor protections. Additionally, private sourcing, complexity, and price appreciation may incrementally benefit returns. The graphic here on page 5 helps to frame LACERA's moderate and broad credit portfolio implementation. The bar at the bottom is a spectrum showing where LACERA's credit portfolio has emphasis. Specifically, again, moderate implementation in the middle of a risk spectrum. Of course, this diagram is illustrative and it's imprecise, but still, it helps serve as a guide when we think that we can refer to as we consider portfolio fit and when we conduct due diligence. This graphic includes desirable implementation attributes. Namely, we seek to invest in evergreen mandates that are multidimensional and dynamic with LACERA's hard hurdle fee structure. We also prefer single investor portfolios, so we're not impacted by other fund investors if they take actions such as redemptions. Let's talk more about what multidimensional and dynamic refers to and why it benefits a credit portfolio. This illustration on page 7 was discussed at our committee meeting earlier this year that Vache referred to. It reminds us that the risks and opportunities within credit investing evolve over time and across a market cycle. As opportunities evolve, different subcategories of credit may become more or less attractive on a relative and risk-adjusted return basis. Accordingly, multidimensional and dynamic mandates may be best positioned to manage a moderate credit portfolio over the long run. This timeline here reminds us that the functional asset category of credit is still somewhat new at LACERA. 6 years ago, there simply was no credit category. And in the recent several years, we've built out an illiquid credit portfolio, we've created an emerging manager program, and we've made several co-investments in credit. We'll tell you more about those developments later in the presentation. We'll also discuss what's working well and what's not meeting stated objectives. Page 9 here shows an 11% allocation target for credit with subcategories named liquid credit and illiquid credit. The current portfolio is within allocation ranges, and our structure review discussion today will discuss both the subcategories. Page 10 shows high-level performance information. And credit has outperformed its benchmark in the recent 1- and 3-year period. The 3-year annualized net performance of 6.8% meaningfully outperformed the benchmark number of 2.4%, and it's driven by the illiquid credit portfolio performing well. Future slides will provide more granular information about this performance. I'll now hand it over to Kwok to discuss the subcategory of liquid credit.
Thank you, Chair. Good morning, Vice Chair Jones and members of the committee and trustees. So this slide shows the composition and relevant benchmarks of the liquid credit portfolio. As Chad mentioned, credit has an 11% total fund target allocation, of which liquid credit is 4%. Within liquid credit, the target allocations are 40% to high yield bonds, 40% to bank loans, and 20% to emerging market debt, which I'll refer to as EMD. We note that the portfolio is in compliance with program guidelines and allocation ranges. This slide highlights performance. The liquid credit composite has slightly underperformed over the trailing 1-year period and since October 2021, the composite's inception. Looking at the trailing 3-year period, high yield bonds and bank loans are meeting objectives, with both portfolios' annualized returns beating their benchmarks. However, the EMD portfolio has struggled both on absolute return and relative to its benchmark over the 3- and 5-year periods. For context, the smallest allocation across the 4 categories within credit is to EMD, which we'll dive deeper into over the next 2 slides. So there's a lot of information on this slide. The main takeaway is that LACERA has not been compensated from a risk and return perspective for investing in EMD. As a reminder, the role for credit is to produce moderate outcomes, both on the risk and return side. The EMD portfolio has experienced extreme outcomes and to the downside. In the middle of the lower chart, we show the maximum drawdown of the EMD portfolio, its benchmarks, and several comparative market indices. This metric shows how much each line item has lost from peak to trough across the measurement period. Since inception, the EMD portfolio has drawn down deeper than the MSCI ACWI IMI, our global equities benchmark over the same period. While we can expect that type of profile for equities which represent growth risk, that drawdown does not align with the credit portfolio's objective. The EMD portfolio has also delivered a negative 0.7% annualized return since inception. In other words, we have slightly less dollars in EMD today than when we started the program 6 years ago. This slide discusses Makita's 10-year expected return outlook for EMD and other segments of the credit market. It shows that EMD on a forward-looking basis is less attractive from a return perspective than other parts of the credit market, including high-yield bonds, bank loans, and private debt. Therefore, not only has EMD underperformed in prior periods, the outlook for EMD is less attractive than other categories within credit. Now, today, we have tools via our portfolio analytics function that we didn't have 6 years ago. The risk exposures in EMD are not unique to EMD. They include credit risk, interest rate risk, and commodity risk, to name a few. These types of risks are currently expressed more intentionally across other functional categories within the total fund. As Vache mentioned, LACERA is working with Makita on the upcoming strategic asset allocation study. And whether or not to maintain a discrete benchmark weight to EMD could be considered as part of that study. Next slide, please. Thank you. This slide shows the characteristics of and trailing returns of the high yield portfolio and its benchmark. This portfolio is actively managed. However, these mandates have limited flexibility to deviate from benchmark exposures. You'll see that over the longer term, this portfolio closely tracks the benchmark. Next slide, please. No, back one. Thank you. Okay. This slide shows the characteristics and trailing returns of the bank loan portfolio and its benchmark. This portfolio overall is working. Similar to high yield, the bank loans portfolio has appropriately tracked the performance and characteristics of the benchmark over the longer term. This slide identifies the liquid credit portfolio guidelines and a few proposed changes, as you'll see on the right-hand column. The two notable proposed changes relate to keeping maximum percentages to non-US geographic and non-US currency exposures and eliminating a specific target. Next slide, please. So in summary, the liquid credit portfolio is meeting its objectives with the exception of EMD. We may consider revisiting EMD's weight in the benchmark during the upcoming strategic asset allocation study. We propose minor guideline changes within liquid credit for the committee's consideration. And at this point, I'll hand it over to Krista, who will talk about illiquid credit.
Thank you, Kwok. Good morning. This slide illustrates the illiquid credit portfolio allocation and ongoing initiatives. Since the last structure review in 2021, 3 new managers have been added to the portfolio. These mandates were onboarded to the DMA platform, which was board approved in March 2021. It's also worth noting that the recent mandates were implemented with tailored economics to better align interests and reduce the fee and expense burden. Additionally, the Emerging Manager Program was recently launched with 1 investment and will continue to be built out to the approved 15% target of the illiquid credit portfolio. This slide further illustrates the growth of the illiquid credit portfolio since 2019. As shown, capital has been steadily deployed quarter over quarter, taking the portfolio from a 1.5% allocation at year-end 2019 to a 6.6% allocation as of June 2023. Importantly, capital was actively being deployed during periods of market stress, notably in 2020 and in the recent several quarters, which created an opportunity to buy assets or lend at attractive prices, providing upside optionality. Slide 23 highlights the performance of the illiquid credit composite. The outperformance over the 3-year time period is primarily driven by implementing flexible mandates that were able to opportunistically deploy capital during market stress and capture the upside as well as mitigate downside volatility. Furthermore, the recently approved credit mandates were structured with terms that are in alignment with board-approved strategic initiatives to strengthen influence on fees and cost of capital. These terms result in optimizing the program's returns, which benefits LACERA's members. As shown, the existing mandates that have tailored structures and terms are expected to generate incremental returns through fee efficiency, conservatively estimated at around $50 to $70 million annually. Here we show the performance of the co-investments of the portfolio. There are currently 3 co-investments, and while it's still early in its life, the program is generating a 17.7% return inception to date with no fees. This co-investment framework is currently set up as an additional sleeve of one of the credit mandates. The framework aligns well with several strategic initiatives, and replicating the framework across the portfolio is a future consideration. Slide 25 provides an overview of the still very early stage emerging manager program. As a reminder, the board approved a separate account manager in August 2022. The program made its first investment in November 2022 in a fund that has a 3-year investment period. As such, performance will experience some J-curve effects during the earlier part of deployment, where performance net of fees is expected to be low. Furthermore, this initial investment was structured with a revenue sharing component where LACERA receives a certain percentage of the firm's total revenue, which will be present in most of the emerging manager mandates, but not all. Slide 26 is quite dense and has a lot of information, but the intent of this slide is to propose more broadly utilizing a framework that currently exists within existing mandates. Co-investments would be structured with existing managers in the portfolio to upsize existing high conviction investments within stated guidelines, including maximum position sizes to mitigate concentration risk. Contingent capital would allow for capital to be deployed during periods of market stress or otherwise to fund compelling opportunities through the currently approved rebalancing governance. Many times, opportunities to invest are short-lived, and speed of execution is key to capturing the potential return. The foundation of this framework would be rooted in alignment to LACERA's strategic initiatives, structured according to the approved guidelines, and only implemented with managers that are in good standing as defined by several factors, including performance, team, operations, and governance. Furthermore, this directly aligns with the investment beliefs that state LACERA's investment processes should be adequately nimble to prudently capture attractive investment opportunities. Each opportunity would be subject to a consent right and CIO approval after considering its fit with several portfolio objectives, guidelines, and available funding. If approved, this existing framework could be expanded to current mandates in the credit portfolio, as well as to future mandates that are approved by the board. Slide 27 shows the proposed illiquid credit portfolio guidelines and the changes relative to the existing. I'll note the two new guideline proposals at the bottom, which carry forward what we just reviewed on the previous slide. The addition of permitting co-investments and contingent capital, as outlined here and on the prior slide with managers in good standing, is a scalable approach to optimize returns in the portfolio. Here we show the separate portfolio guidelines for the emerging manager program. There are proposed changes to the definition of an emerging manager, as well as several new guidelines listed. The changes to the emerging manager definition are meant to simplify the defining criteria, specifying the criteria are applied at the time of the investment, not throughout the life of the investment. The new guidelines propose graduation and redemption definitions and parameters, such that each mandate within the program will eventually either graduate to the direct portfolio, no longer qualifying as an emerging manager, or be wound down. As a reminder, future graduations are a goal of this program, but may not always occur. In summary, if this structure review is advanced and approved, it would result in adopting the portfolio guidelines as previously discussed, and it would approve the co-investment and contingent capital framework. Here's an overview of the credit initiatives. Since the last structure review, the Emerging Manager Program was established with its first investment made at the end of last year. Additionally, 3 new mandates have been successfully onboarded to the DMA platform. The portfolio continues to deploy capital to the direct portfolio as well as to the Emerging Manager Program, while legacy mandates are winding down as previously approved. In terms of outlook, the strategic asset allocation study is underway, and once approved, the team will evaluate the credit portfolio framework and objectives against the approved allocation and respective policy. This slide summarizes the recommendations by portfolio components. Within the credit portfolio structure as a whole, no changes or recommendations were made. In liquid credit, there were some proposed guidelines that Kwok spoke to. And lastly, for illiquid credit, in addition to the proposed guidelines, there is a recommendation to expand the co-investment and contingent capital framework. That concludes our prepared comments. We're ready to stand for questions.
Thank you. Do we have any questions?
Yes. Good morning. Thank you for the presentation. So 2 quick questions on the emerging markets. So perhaps this could be for Tim. It's the issue of the performance global wide, or is it that a portfolio is concentrated in a particular region? Can you elaborate a little bit on that?
Sure. I wouldn't say there's anything specific to the LACERA portfolio. The overall category of emerging market debt over the last 3 years has really suffered relative to other asset categories. Sort of a perfect storm of factors emerging from COVID and the impacts that had, particularly on China. China obviously represents a fairly high weight in that particular index. To the rising rate environment, strong dollar environment typically is very difficult for emerging market debt. So there are a lot of different factors that led to that, but there's nothing specific to LACERA performance overall. It's more just the economic and sort of capital markets factors impacting the asset class.
And the expectation is for that environment to remain in the near future, or what's your best guess?
Certain parts of it, I think, yes. So the rising rate environment and the strong dollar environment likely is sort of at or near its end, I would say. So there could be some reversal in that factor. But I would say overall, that's also going to correspond with a slowdown in overall global GDP, which likely for the emerging market economies, which are, part of that growth equation, fundamentals look a little less appealing, certainly on that front as well, even if you do have reversal in the strong dollar.
And we're going to revisit this at the asset allocations. One more question on the Emerging Manager Program. The proposed change for graduation, which I welcome, I think it's a maximum, 3 to 12 years. Does that serve me correct? So what's the logic for 12 years? I thinking that 12 years, I know that's the, that would be the ceiling, right? Is that too long? From my perspective, I mean, ideally, I would like to see graduations within 5 years. Maybe 7 years, but 12 years, if you can talk to me a little bit about the logic behind the 12 years and why not 8, 7 years?
I understand the question, Trustee Santos, and thank you for it. I think it's important to acknowledge that it is the upper end of a range, and we also would like the graduations to be common and sooner. What we're finding is that illiquid credit investments may be in a closed-end, long-lived vehicle, similar to a private equity vehicle that has a 3-year investment period and a 7-year, period after that, maybe with a couple singular year extensions. It may take that long until realizations occur to investors for us to fully evaluate. We were thinking about a range of 3 to 12 to accommodate that type of scenario where we need a longer time period to fully evaluate the manager. I'll contrast that with, the guidelines in hedge funds don't extend this long because the investments are marketable and valued every month, and we can evaluate that over a 3 and 5 year period. So this is just trying to capture the longer lived vehicles as opposed to excluding them.
Great, thank you very much, Madam Chair. Although I don't have a vote, I'm supportive of the changes.
I also don't have a vote, but I just want to throw a comment out there for consideration as you go through your review. So the comments on emerging market debt, I know this has become kind of the commonplace structure for creating these credit benchmarks to sort of do a slug of this, a slug of that, and a slug of emerging market debt. And I think one of the challenges and thoughts to consider is, the interest rate environment has certainly been pretty punishing. The credit, the dollar, the strong dollar has been tough if you're investing in local currency. But also, I want to also consider when you're doing this, the differentiation between sovereign debt and corporate credit. And the reason for that is it's my strong view that that globalization is having kind of we're taking a reconsideration of globalization post-pandemic. In fact, most will say that we're slightly deglobalizing. And while we may not get fully onshore because it turns out it's more expensive than we're willing to pallet as a country in terms of inflation and how much it would cost to actually pay people, living wage and benefits, nearshoring is becoming a bigger opportunity. And one of the most underpriced areas in the world in emerging market corporate credit has always been Latin America, and one that is poised to benefit greatly from this nearshoring trend that's probably going to take about a decade. So this isn't a kind of immediate opportunity. I mean, this is a now opportunity, but it's one that's probably going to take some time to for that theme to play out. And with that, because emerging market corporates are ceilinged by the credit rating of the country, you can actually get some very, very high quality corporates that are kind of underrated relative to their actual quality because they face the ceiling of the sovereign. So just something to think about as you go through this process, to really differentiate the difference between sovereign and corporate, and also just sort of consider this globalization trend and how it might present opportunities for us to make investments that could be very valuable relative to what we're buying and what we're getting in yield. Just a thought.
Yes, thank you.
Thank you.
Thank you. Could I just add something there? Thank you very much. Just not to tip the hand of future discussions too much. One of the things that we've been working with the credit team on discussing is this concept of slightly more flexible mandates and implementation. So multi-asset credit. So while we may look at not having an explicit allocation to EMD and having it as a benchmark weight, in no way, shape, or form do we want to limit LACERA's ability to approach that asset category when those attractive opportunities arise.
Thank you. Are there any other questions, comments? Sure, Mr. Green.
Yeah, sorry, just bear with me on some of these things. The benchmarks, I have a question on the benchmarks, just as a point of information. I understand, is there comparative benchmarks, or are they always the same benchmark that you guys use to value?
The benchmarks are specified as part of this strategic asset allocation process.
Okay. I mean, but
Do you have any specific benchmark questions?
No, just that when you use those benchmarks, are they consistent? Is it part of policy?
Yes.
Okay. All right. Portfolio veto, some of the changes. My question is do we currently have, can you please go into what that means? I mean, do we currently have portfolio veto on slide 27? That's one of the changes that you put in as a new guideline in illiquid credit. Maintain portable fit veto. Is that something that the manager that LACERA has currently? Do we have influence in that area?
In the current mandate where we have a contingent capital sleeve, there's a consent or veto right that LACERA maintains. So this is just expanding that to other good standing managers. But yes, it currently exists.
Okay, thank you for that. Again, sorry for the time, but the proposed adjustment for contingent capital, I mean, that's obviously the body behind that is to give us more agility, as you discussed, and that reallocation is how significant is it going to be?
Do you want to take that? Bashi, do you want?
Yeah, no, go ahead.
Yes, it's to provide appropriate agility. How significant is it going to be? I should take a step back. The current governance that's in the IPS allows for this. While describing contingent capital, as Krista did today, I think that we're communicating to a greater degree about when we might do rebalancing events. Not always is it to reach strategic targets if we're underweight to cure that, et cetera, but sometimes it's for opportunistic purposes. And how great would it be? It would never be to an amount that exceeds the allocation ranges in the investment policy statement. That would be a maximum. Gotcha. And it would never be in an amount that makes us uncomfortable that we're leaning too much at a singular point in time. We don't like to make quick and heavy investment decisions. So it would be quite scaled.
It allows you to stay packed for bear at all times, right?
Yes.
Gotcha. And then, without drawing too much more time, the footnotes, like as an example on 23 and 26, there's a lot of information in those footnotes. And I would just ask that maybe that's even given its own slide. It's, it's, I understand it's a footnote, but, I'm here to, get educated on it too. And I'd like to see that kind of stuff on some type of slide that's easier to read if possible.
We hear you.
Yeah,
We'll take
appreciate
care.
that.
Yeah,
That's it.
we'll do
Yeah.
that.
So,
Or maybe-
23 especially, it's very busy. So that's
Okay.
it. Great presentation, great package here. Thank you for the work in it. Thank you very
Thank
much.
Thank you.
Thank you. Trustee Santos.
Yes, thank you. One more question. On the co-investing, the CIO has the discretionary authority? Yes?
Yes.
Great. I would like to suggest to my colleagues that we should provide the CIO with the, discretionary authority in this functional asset class. But only for co-investing. I'm talking about the whole, yeah.
That's a good idea.
So explain, if someone could explain what authority that would mean.
The way I'm thinking of is that every time staff determines that the additional investment should be made, and they go out and search for a manager that is going to be the right fit for us, it will be more expeditious to have the CIO have the full authority reported obviously to the board, like he has been doing with providing those reports. We have, and we're going to be discussing the investment committees or committee that the staff has. I mean, typically for any recommendation, it goes through the staff investment committee, it goes to the consultant investment committee. Those two committees are independent. They have to agree on the particular recommendation. The CIO then review it, and correct me if I'm doing this incorrectly. The CIO approve it, and then it comes to the board. So what I'm suggesting is that all the process, once the two investment committees make a recommendation and the CIO agrees with that he will have authority to make the allocation of the investment, right? Because we now moving from allocators to investors with full report to the board, with full transparency, just like the CIO has been doing, and it will include the report from the consultant as well. So that will be my suggestion. Again, I don't have the ability to, I think I do, Mr. Rice, I do have the right to make a motion. I just cannot vote. Is that true? Or we cannot make it. Okay, so that's my suggestion for my colleagues.
That if I may, that bears the question, will that help? Will that, is that something that would help?
It's in my view, and then Mr. Greb will respond to that. It is certainly it makes it for more expeditious movement and ability for the staff to move quickly. They spend a lot of time preparing for these meetings. I mean, I can imagine how many hours, days perhaps, that the staff spend in getting ready for this presentation. Well, this presentation is right on, because we need to understand this. But I think once we approve the different policies and guidelines, then it should be up to the staff and the CIO to implement that. report it to the board.
Through the chair, good morning, trustees. In terms of does this benefit, it doesn't really change our process in any dimension. It effectively changes the presentation to the board. So the team will effectively spend more time diligencing and underwriting as opposed to preparing for presentations. But as it relates to the diligence and the underwriting, that stays the same.
And that will be reported in
Yes.
your report.
I have a few questions, just so I can understand the full piece of what you're recommending. So, and we're only speaking on credit, correct? This credit.
Yeah, this.
Right.
Yes.
Okay. And then is there any, are we putting any parameters like up to a certain amount, or is it just the amount that's been allocated to this particular asset class? Is that what we're?
It will be with,
saying?
it will be within the current guidelines that we have established for the program.
Mm-hmm. Okay.
All we're doing is expediting the process. The process will stop with the CIO approving it, subject to reporting to the board.
Understood.
I think one of the things that is hugely beneficial is that it does allow the staff to move expeditiously when opportunities present themselves. And so it hugely benefits our ability to make investments that we otherwise wouldn't be able to move quickly on, just because the process of getting it through committee and then onto the board can be a long process. So I think that's number one. Number two is that the presentation, as you know, as we're envisioning this, is that the presentation to the board remains the same. The only difference is that that it will be reported to the board rather than the board making a final approval. And so you still get the same package, the same diligence package, the same kind of background and support that you already get. And I think that was Mr. Grable's comment, that it doesn't change the underwriting or the process for material preparation. So it's not changing any of that, but it means that we as a board will be concerned with policy, and we will be concerned with reading through those materials to ensure that we're comfortable with the process. It does mean the board has to get comfortable with the process. So there will be, I think, more and direct education that goes with that.
Okay. I have a few questions. I guess one piece I did want to understand in regards to what Trustee Sanchez is addressing is, have there been investments that we have missed out on because of the timing? In order to bring it to the board for approval, there's a delay. Have we actually missed out on anything? Has this already surfaced as an issue?
I'm not aware of anything that we've missed out on, but we may not have looked at anything knowing the constraints.
Mm-hmm.
So indirectly we may have, but nothing direct comes to mind.
Okay, understood. Thank you. Okay, if we could shift back to the presentation, because I did have a few questions remaining on the emerging market debt category, which obviously is the topic for the day. I guess I wanted to have an understanding of how staff sees this particular market. You know, obviously we've made it a part of our portfolio. How is this cycle work for this particular category in the economy? Is there a certain time when this is a more appetizing, section to get invested in? I see Mr. Grable standing up. Do you have some comments, Mr. Grable? Thank you.
I didn't. The team can go into more detail as it relates to emerging market debt writ large. And I think that the comment that I have is really in the theme of what Ms. Sanchez and what Tim was mentioning, that EMD, rather than being a very benchmark-driven implementation, is what we have, where the benchmark says X% to country X, Y% to country Y, and there's very little room around that. What we would rather see going forward is identifying individual securities across the globe, as opposed to being benchmark driven and just investing at, a certain percentage in sovereign debt, a certain percentage in corporate debt, a certain percentage in local currencies, a certain percentage based in US dollars. So this is going forward. We think of that there's a really attractive opportunity across all time periods of all regions and all types of securities. But does that belong as something that's defined programmatically in the benchmark?
Thank you. And I had one other question on the recommendations for the guidelines. Let's see if I can. We're going there. Not for liquid credit, illiquid credit. Thank you. And this was under co-investments. So this is presented, it says it's a new guideline, but I understand that there are guidelines already out there for co-investing. But what is this doing differently, I guess? Is it, when it says not to exceed 20% of the manager's mandate, is that all new? Is that what we're saying is new, or is it increasing, or?
The co-investment framework currently exists within a current credit mandate as a separate sleeve within that mandate alone.
Right.
So this guideline is meant to expand that existing framework to the total credit, illiquid credit portfolio.
I understand. Okay, got you. With the parameters of the 20% and the 3%.
Yes.
And is that consistent?
Yes.
Understood. Good, Mr. Kelly is back. Because I think, or Mr. Knox, sorry, I think we needed Mr. Knox, correct?
No, we have a quorum. He's not on the committee.
Okay, got it. All right. Any other questions? Final questions, comments?
I just, real quick, what can you describe what special situation lending is? Slide 15, the Makita report, it shows, it's highlighting the emerging market, in comparison to other markets and their return over the 10-year projection. What's an example of special situation lending?
Vache, maybe I'll just weigh in real quick,
okay,
and then
thanks.
you can expand
Yeah.
on it. Essentially, the category that we use in our capital markets expectations is the combination of both mezzanine debt and distressed debt. So distressed debt can be tied to economic cycles, or it can be tied to very specific company events. It, by nature, tends to be an area where you have to be fairly nimble to take advantage of either legal or regulatory rulings, situations as those evolve, or rapid changes in economic conditions that create distress. And mezzanine debt, I think you've seen some examples of it in your own portfolio tied to certain real estate assets. Added levels of complexity often involve legal workouts, things along those lines. So we just lump those two categories together and call them special situations. But it can really mean a tremendous number of things under the hood there. It's kind of designed to catch a lot of things where complexity is high and agility may be required.
All right, thank you so much. Okay, so I believe, do we need to take a vote on the changes for the guidelines? Is that something that's needed to be done today? Or this is just the proposed? Okay.
We need a motion.
Okay, so we do need a motion for the proposed change in the guidelines that have been presented here for illiquid and both liquid credit.
I'll move.
So
And I'll second.
Does that
no, it
include,
doesn't include that for this one. Hold on, I'll get to that. Oh, do we have to vote?
So
Wait,
can we
point-
do one motion? So approving the guidelines and any other changes that are recommended? Or
I'd like to do a separate
Okay, then we'll do the second one. We'll do roll call.
Clarification, if we make an amendment, would it be an amendment or would it be a completely separate? Because don't we have to do the,
It has to be one.
yes, the motion, if we're making an amendment that Mr. Santos suggested for us, don't we have to take that vote first, make that motion first, take that vote? Because if we vote on the agenda item now, then it closes it. Yeah. So I think it needs to go the other way.
Has to be done all at once.
Okay, so we'll back into.
Yeah. Do we since the motion's on the floor,
On the point of information, so the motion has to also state that this committee is recommending it to the board because the board has the final approval on that. So just make sure that the record
the
reflects.
point of order, since there's a motion on the floor, how do we,
Make an amendment.
go backwards?
You make an amendment and then the seconder has to
Okay.
make.
So could I make a friendly amendment? Oh, yeah.
Okay, so it was moved by Mr. Green, Trustee Green.
Yeah.
So he could
Anybody.
propose the amendment if he wished, correct?
Anybody.
Mr. Rice, just for a point of clarification here, if you could weigh in on this, I'd appreciate that. What would be the process?
Anybody.
Accepted by the motion maker and the seconder.
Right, okay.
There's no motion.
Yeah, we do have a motion.
There is a motion.
There is a motion.
There is a motion.
But it hasn't been seconded.
Yes, it's been seconded.
Yeah.
I wrote it.
So I'd like to make a friendly amendment to the motion. And if Mr. Santos could help me wordsmith it so we get it correctly on the giving the discretionary on the credit to make a recommendation to the board. So Mr. Santos, can you help with the wordsmithing?
Yes, that for this asset class, the board will provide the CIO discretionary authority to make decisions regarding investments in this particular asset class, subject to reporting to the board in writing, explaining the due diligence, the outcome of the consultants investment committee and the outcome of our internal investment committee.
Does that make sense?
So we have a motion. It's been amended. I will say my concern with the amendment is not to our Mr. Grable. My concern when we change it, we're naming the position. So the position itself has that authority and the CIO, correct? Which is right. And so that could work out well right now. And 5 years from now, that may not be a good decision. So I'm hesitant in the amendment portion of it.
Can I make a comment on that as well? This, first of all, this will go to the full board. So the motion here and the amendment, which hasn't yet been accepted, but the amendment would go to the full board for conversation. The second thing is that the board controls the policies, which means that if it becomes a problem in the future, then the future board can rescind that authority. And so I would be cognizant to make policy for the team you have, not the team you think you might have. And create a process that is nimble enough to respond if change needs to be changed.
Understood. All right. Do we?
Mr. Green and Mr. Roof, you can vote.
Mr. Green has to accept it.
Yeah.
I accept the friendly amendment, and I understand that this will go to the Board of Investments to be discussed and vetted. So I'm good with it.
Can you guys? Okay, so you're both yes. Okay. Okay.
And this is
It's the credit structure review.
and as amended, correct?
So yes, it'll be amended in the minutes. Okay.
Okay. So moving on, and we are short time. So we have a presentation for the next item.
Yeah.
Yes, Madam Chair, if I could ask for your direction on timing. It's going to take more than 2 minutes.
Yes,
Can
no, we are aware, we gave ourselves a good 30 minutes of latitude here, so you have the time you need.
Okay, we'll try to go through it quickly. So hello again. We'll turn to a structure review of risk reduction and mitigation now. We're going to follow the same approach as before. Examine goals and objectives, existing structure, performance, recommendations, and initiatives. My earlier comments about having engaged in a comprehensive review apply. And once again, we went back to basics, took a fresh look, and ended up not very far from where we started. So I'll start the overview as well as cover the sections on cash, investment grade bonds, and long treasuries. Then I'll hand off to Jason and Chad to cover hedge funds. As a reminder, Jason's the newest member of our team, having joined in June. So bear with me 1 second as I go to page 3. Okay, this page shows the role for the overall risk reduction and mitigation category, as well as the specific objectives for each subcategory. At the top, you see goals such as liquidity, capital preservation, moderate income and return, and low correlation to growth. These shared objectives are represented to varying degrees in the 4 subcategories. For cash, the most important consideration is liquidity. Paying the promised benefit is paramount so that we have cash on hand when needed. Also crucial is capital preservation. For investment grade bonds, liquidity and income generation are key considerations. For long-term government bonds, the key role is diversification, given the historically negative correlation to growth assets. That didn't happen in 2022, but as we discussed before, that was a bit of an aberration and an outlier. For hedge funds, as implemented at LACERA, the objective is to enhance risk-adjusted return with very low sensitivity to stock and bond markets. This page shows that the risk reduction mitigation category comprises 19% of the total fund, and the colorful part of the pie chart shows the allocation targets to the individual categories. 7% to investment grade bonds, 6% to hedge funds, 5% to long treasuries, and 1% to cash. Right? The upper left section of this page shows the performance of the overall category. You can see that in the 3 years ending June of this year, the category outperformed its benchmark, down 1.7 versus the benchmark down 2.6. Now, of course, outperformance is good, but negative return is disappointing. And it's attributable to the unusually large negative returns in calendar year 2022 for investment grade bonds and long-term treasuries. As I mentioned earlier, 2022 was a very unusual year for bonds, both in terms of the magnitude of negative return and the correlation to stocks. In the 47 years since 1976, which is as far back as the aggregate index data go, 2022 was the only year in which both stock and bond markets had negative returns. Furthermore, in those 47 years, there have been only 5 calendar years with negative returns for the bond index. And prior to last year, the worst return for the bond index was down minus 2.9%, whereas last year was down 13%. That was a real outlier. In the bottom middle chart, you can see that for the 3-year period, hedge funds outpaced their benchmark by a very wide margin. We'll get into that a little bit later. In the lower right, we can see that long-term treasuries, which were added in the 2021 strategic asset allocation, outperformed their benchmark, though again with a negative return. Right. So let's turn to the specific sections, and I'll go rather quickly. Cash. We've already talked about the importance of liquidity in the cash portfolio. We use cash to make benefit payments, and cash is also the nexus for all portfolio rebalancing activity. LACERA's cash is invested in very short-term U.S. Treasury and agency securities, as well as repurchase agreements collateralized by U.S. Treasuries, agencies, and mortgage-backed securities. And we always maintain enough cash to make at least 3 monthly benefit payments. Now, I already mentioned that turning to investment grade bonds, that a second source of liquidity is the objective after cash. I'm going to skip over this because we've already covered a lot of it. This page shows on the left side the structure that was adopted in 2021. And on the right side, we're showing the recommendations for this year. And there's no material change, really. In 2021, we adopted the structure of 70% target to an index account, 30% active, but by active, we mean core, low active risk. As you recall, we eliminated Core Plus because its risk profile wasn't consistent with the objectives of risk mitigation. So the heavy lifting was done in 2021. We're really not making any material changes. This page just shows a comparison of the composition of the investment grade portfolio compared to the index, whether it's by sector, you can see treasuries, corporate bonds, mortgage-backed securities, et cetera, or by credit rating. The alignment with the benchmark is quite high. I will direct your attention to the lower left, the box that represents the risk data that we get from MSCI BARA. I think the key point I want to highlight is that portfolio, even with that 70-30 mix, has a beta of 1 to the benchmark. And the active risk is quite low at 20 basis points expected tracking error. Moving along, not much to add to performance. It's done better than the benchmark, but it's still negative returns always hurt. And I've already talked about the environment. The guidelines here, really what I want to draw your attention to is it's not a material change, and it's just more formalizing rather than putting a lot of the restrictions in the individual categories of sector, geography of currency. We've aggregated all in the eligible investment section down below. The basic rule is if it's eligible for the benchmark index, if the sector is eligible, then it's eligible for our portfolio. Simple as that. So the recommendation is just to affirm what we have in place, and along with the minor revisions to portfolio guidelines. Long-term treasuries, again, not much to add. It was added following the 2021 structure review. You will recall that we conducted an RFP, or we issued an RFP, conducted a search, hired a manager, and then used a transition manager to coordinate the sells and the buys as we were selling down investment grade bonds and increasing long treasuries. So it's performed, since that time, it's performed as expected. Here, again, you see a comparison of characteristics versus the benchmark, very close alignment, whether it's in terms of duration, 15.99 for the index versus 15.98 for the, for the portfolio versus 15.98 for the index. It is an index fund, enough said. Again, the portfolio, though it outperformed, it's still disappointing. On this page with the guidelines, there's really nothing new here, but the last time we came to you with a structure review, we didn't have a manager in place. So these guidelines are what is in the investment management agreement. And so we're just formalizing it, saying, okay, it's now in the category rather than for the manager. With that, so again, because it's a passive implementation, we're just asking you to reaffirm in a sense and adopt the minor modifications. With that, I think I'll turn it over to Jason, who will cover the role and objectives of hedge funds.
Thank you, Vache. Good morning, Chair, committee members, and trustees. As mentioned, we will now cover the hedge funds portfolio. On page 22, we have a broad overview of LACERA's hedge fund program. To ultimately mitigate risk, the portfolio is designed to provide moderate returns while maintaining a low sensitivity to major markets. The return profile, as detailed in the honeycomb, is expected to be frequently positive and provide protection during market downturns. The next page depicts LACERA's program in relation to alternative hedge fund strategies. On the top right are more aggressive, directional portfolios that accept high levels of risk in pursuit of lofty returns. More conservative tail hedging strategies in the lower left are designed to offset the losses of major downturns, but often result in performance drag. LACERA takes a middle ground, absolute return approach with modest expected returns and minimal market risk. Since the last structure review in 2021, we have completed the initial build-out of a direct hedge funds program after previously relying on 2 fund-of-funds managers for implementation. We have also adopted an emerging manager program. With respect to the total fund, the hedge fund portfolio is ramped up to the intended target allocation of 6%. Ongoing initiatives involve monitoring of the portfolio, building a reserve manager pipeline, and ramping up the emerging manager program. It should be noted that the portfolio structure is much more diversified than may appear in the pie chart, with each of these managers employing several or even dozens of sub-strategies. The following 2 slides highlight some results of the program in recent years. In the top left graphic, we can see that equity markets in black drew down materially in both 2020 and 2022. Over that same time frame, the hedge fund portfolio in green exhibited significantly less downside volatility and effectively preserved LACERA capital. This chart, as well as a 3-year trailing beta of 0.04, demonstrates risk mitigation through a low sensitivity to major markets. Beyond downside sensitivity, the returns of the portfolio are notably efficient on a risk-adjusted basis. In this context, efficiency refers to greater returns with less risk or volatility. This can be visualized in the bottom right graphic in green and is further supported by a strong 3-year Sharpe ratio of 2.3. Relative to the benchmark, the portfolio has underperformed in the recent year, but has outperformed over a 3-year timeframe. The outperformance can be attributed to the positive returns often achieved during months when equity markets were negative, as seen in the top right. This graph paints a clear picture that the hedge fund program, shown in the blue bars, successfully mitigated risk during months when equities declined. In the last calendar year of 2022, the hedge fund portfolio delivered a positive 7.3% return, while broad equity and bond markets fell 18 and 14% respectively. We are pleased with these results as they indicate the program is achieving its board-approved objectives to mitigate risk and preserve LACERA capital. I will now hand it back to Chad for the emerging manager program.
Thank you, Jason. This slide here provides an overview of the emerging manager program within hedge funds. The program launched 2 years ago, has invested in 7 newly created firms, and is nearly 75% deployed relative to its target size. Early performance metrics show that the program has underperformed the hedge fund benchmark, but the program has mitigated risks by delivering flat returns in a time when both equities and bonds have lost money. As a reminder, manager graduations are a goal of the program, and we're optimistic that several underlying managers will compete as strong candidates in the coming years to graduate. This slide has guidelines for the hedge fund program with 2 recommended minor edits to the existing guidelines. One edit lowers the risk range by 1%, and that's consistent with uplifting the risk mitigation objectives of the overall program. And the second change specifies a 3-year trailing measurement period for market sensitivity. This next slide here has guidelines for the emerging manager program with 2 recommended minor edits, several recommended edits, and consistent with what Krista mentioned in the earlier session and Vache mentioned earlier on this item. These changes are meant to clarify defining criteria and to provide a framework for how graduations would be considered in the future. In summary, here on page 30, the hedge funds program is performing well and it's achieving its goals, and we'd like to maintain the portfolio framework and make clarifying modifications to several guidelines. In terms of upcoming initiatives, for risk mitigation, they're shown on this slide, and they include continued build out of the hedge fund emerging manager program and launching a routine RFP towards the end of this year regarding an asset category consultant for hedge funds. Lastly, page 33 here summarizes the recommendations across the sub-portfolios, the subcategories. As a reminder, the risk mitigation portfolio overall is performing, it's outperforming its benchmark over the recent 3 years by 0.9%. That's annualized. And that positive margin is pretty big in the risk mitigation category. We're pleased with that. The outperformance is driven by the hedge funds program. Several years ago, the board decided to build a direct hedge fund program. And today, that prior board decision is driving the outperformance. With that, in the interest of time, we're happy to stand for questions.
Any questions?
Just good job on that. $1 is better than no dollars, right? So, I mean, that's really good.
Protecting capital.
Yeah.
All right, so do we have a motion then to approve the proposed changes to the guidelines?
I'll second.
Okay. Do you guys, Mr., do you see the vote on your screen? You can just vote. Do you see it? Oh, you did? Okay. Mr. Rue? Okay.
All right.
Okay, the motion passes unanimously.
You're gonna cut out like half an hour of conference.
All right, so let's go back really quickly now that we have a quorum to go to item 2 for the procedure for teleconference meeting attendance under AB 2449. Can I get a motion to approve that?
So we don't need a motion.
We don't need a
for that.
motion,
Yeah.
all right. Moving on to item 3, approval of the minutes. Approval of the minutes for the regular credit and risk mitigation committee meeting of May 10th. Were there any changes or can I get a motion? I'll second.
Okay, the motion passes unanimously.
All righty. Items for staff review.
I don't have anything.
We don't have any notes from that. There was a discussion about maybe footnotes. Making them, so if they're important footnotes, make them a slide. And then items for future agendas. Nothing. All righty. Good of the order. Nothing. Does anybody have any final words? Okay. Well, then with that, the meeting will be adjourned.
All right.
Thank you.
Thank you, everyone. Thank you, team. Those were fantastic presentations. So let's go ahead and just take 5 minutes to